So I believe that that point right there, which was July of 2020, was the end of the bull market in bonds. And this one is the bond bubble. And since it's a bond bubble update, it's a update. And don't worry, I will stop with the stupid puns and jokes after the next one of this series, because that's the final one. So this is the 3-month Treasury bill, and the 3-month is the market that the Federal Reserve intervenes in most to control interest rates. These are short-term interest rates. And I've got a close-up here showing their super aggressive action going from less than 0.1% all the way up to 0.75%. But take a look at this in historic perspective here, and you see that their actions so far haven't been all that aggressive, but they are happening sort of fast. I mean, if you look here, back here, they were trying to raise rates here very slowly. This is Janet Yellen, and she caused the markets to sort of stall out, and so she stopped, and then Jerome Powell took over in 2018, and then ran into a problem in August and July of 2019. There was a problem in the repurchase agreements markets, and the Fed had to create a bunch of currency and fix that and continue dropping rates, and then we have the global health crisis right there. But what's interesting, you look at this historically, and the Federal Reserve was raising rates here. This is Alan Greenspan raising rates, and he was trying to slow down something he called irrational exuberance. These markets were just going crazy, and he popped the NASDAQ bubble, and it started the markets, because all the markets started crashing, not just the tech stocks. And so he goes, I'm going to cause a depression or a recession. And so he starts dropping rates, and right there is where the recession started to happen. He continued dropping rates, and then he held them down way too low after the recession was over with, and didn't even see the real estate bubble that he was creating by keeping rates so low. And so he very slowly and methodically tried to raise these rates without disturbing the markets, bringing us in for something he called a soft landing. He was just going to slow down the economy, and then handed the ball to Ben Bernanke, who was left with the Greenspan bust. This is the second Greenspan bust, and because he caused the NASDAQ to pop also. But he also caused, the Federal Reserve is partially to blame. In fact, the majority of the blame rests on them for creating all of these bubbles and then popping them. And so this starts to deflate. We've got the global financial crisis of 2008. Ben Bernanke keeps the rates, takes them down to practically zero, and just keeps them there way, way, way too long, and creates the disaster, these bubbles that are in today, and there is no way out of this. When they started raising rates back here, when this was going up, we weren't in bubbles. You didn't have when the inflation was raging in the 70s, you didn't have a stock market bubble. In fact, the stock market had a crash in 1974. They raised these rates in 73, and it popped that bubble. The market crashed in 74. They lowered rates again, but inflation started heating up, and they raised rates again. But the stock market had bumped its head in 1966. The Dow Jones Industrial Average hit 1,000 points in 66 and couldn't decisively break through until 1982. During that time, there was raging inflation. And with raging inflation, if the stock price doesn't go up, it means that the companies, you've got an economy that where goods and services are going up in price, and so there's more earnings per share. And what happened was the PE ratios came way down on all of these stocks. Stocks were very undervalued by 1980, 1982, when they began their enormous bull market. And then we had this disinflation, lower inflation and lower interest rates year after year in the economy. But Alan Greenspan created a bubble, popped a bubble, created a bubble, popped a bubble. Ben Bernanke cleaned that up by creating the massive, dangerous, lethal bubbles that we find ourselves in today. And now they think they're just going to be able to raise these rates in the midst of being trapped in all of these bubbles that they have created. It's not going to, you can see the future, and it's not going to work out well. This is market yield on U.S. Treasuries. This is the 10-year. So the 10-year Treasury, but it's going down. Why is this going down? Aha! I inverted this. That's a minus symbol there. So it's the 10-year minus the 10-year times 2. Times 1 would be a 0 flat line. If you minus 10-year times 1 flat line times 2, you exactly invert it. And I'll show you why I did that. Let me give you the long-term perspective here. And what you see is this gives you perspective. This is a bull market. When yields are falling, that means bond prices are increasing. And the thing about this is the 10-year. The 10-year, if they try and take long-term bonds, it would mean they'd have to take the whole spectrum of bonds, bills, and notes negative to keep this bull market going. And we got here to 0.5% basically, and you can't go past this zero. The free market can't go past this zero line. The only way you could go past the zero line is for intervention from the Federal Reserve. They would have to be buying massive quantities of these bonds. And to do that, they create currency. When you create currency, you get more inflation. They are trapped. There is no way out of this mess. So I believe that that point right there, which was July of 2020, was the end of the bull market in bonds. And so we'll get back to this, the right side up yield curve. And what I notice here, let me go back to the inverted for a second. This is a head and shoulders pattern. You've got a shoulder and a head and another shoulder. You draw a line across those two, the beginnings of the shoulders there. That's called the neckline. You invert it. That's the predicted move. It's already fulfilled the predicted move. But I mean, how can this come back down below zero? I don't think it can. Now, I'm going to visit my early warning seminar, the predictions that I had back then when it came to the aging bull market in bonds. So this is long-term interest rates. This is from Robert Shiller's data, Dr. Robert Shiller. But one thing that I've noticed for a long time is there's sort of a cycle going on here. And what I did was I took these minimums. This is a little bit lower than that interest rate right there, and then this minimum. And I drew lines there, and I measured the number of months from the peak on either side, and I found that you could exactly balance an arrow on top of that. And then I went from this minimum and balanced an arrow of the same number of months, and it predicted that somewhere, I said that somewhere between 2020 and 2023, this bond bull market will be over with. The bubble in bonds will have popped, and we will go into a bear market in bonds. And I believe that is exactly what is happening. So the point is, all bubbles burst. When a bubble bursts, it can be, this is an economic bubble, and these are almost all sectors of the economy. A lot of people have said this is the everything bubble. I've said this is the everything except gold and silver bubble, because when a bubble bursts, it can be disastrous for the economy, but it can also be disastrous for your personal finances. So take care of yourself and protect yourself.